Imagine this. It's 40 years from now. You're done working, you're ready to travel, relax, enjoy life, finally collect the rewards for all those years of discipline. So you open your brokerage account, and instead of feeling freedom, you feel sick because you realize you're missing more than $200,000. Not because the market crashed, not because you were irresponsible, not because you never invested, but because years earlier, when you had just your first $10,000, you made one choice that felt safe, and that safe choice quietly cost you a fortune. We've all heard the pitch: live off dividends, build passive income, get paid every month. It sounds incredible. It sounds smart. It sounds like financial freedom. But if you're a beginner investor in the United States today, that dream can actually keep you stuck. And in this video, I'm going to show you exactly why. Not with hype, not with guru talk, with math. Real math. The kind that shows what happens when you put $10,000 into dividends versus growth. And once you see this, you may never look at monthly income the same way again. Let's start with reality. If you're in your 20s or even your early 30s and you've got $10,000 saved for retirement, first of all, that's a win. Seriously, a lot of people are nowhere close. So if that's you, you're already ahead of more people than you think. But now comes the real question. What is that $10,000 actually doing for you? Most people start with the obvious choice, the S&P 500. 500 of the biggest, most established, most dominant companies in America. It feels safe. It feels proven. It feels like the adult answer. And long-term, it's been a great place to build wealth. But if you put $10,000 into the S&P 500 today, your dividend yield is less than 1.5%. That means you're making about $150 a year. That's around $12.50 a month. $12 a month. Let that sink in. That doesn't even cover a Netflix subscription and a bag of chips. So naturally, your brain says, okay, I need something that pays more. And that's where beginners make the turn. They start hunting for higher yield dividend funds, something with a 4% yield, maybe more. Now your $10,000 pays about $400 a year. That sounds better. That's about $33 a month. And for a second, that feels exciting because now you're getting passive income. But here's the pattern interrupt. $33 a month is not freedom. It's not retirement income. It's not life-changing. It's dinner. One decent dinner. That's it. And the question almost nobody asks is, what did that dinner cost you? Because income is only half the story. The other half is what your money could have become if you had let it grow harder, faster, and longer. And that's where most people completely miss the plot. The reason the S&P 500 doesn't pay a huge dividend is because many of the biggest winners in the market aren't focused on sending you cash today. They're focused on turning profits into expansion, into innovation, into dominance, into a stock price that compounds like crazy over time. Think about companies like Apple. Think about Amazon. These businesses didn't become giants by handing out giant checks early. They became giants by reinvesting over and over again, back into the business, back into growth, back into scale. And if you're young, that is your advantage. You do not need $33 a month right now. What you need is hundreds of thousands of dollars later. Say that again. You do not need $33 a month today. You need $300,000 later. That's the game. That's the mission. That's the mindset shift. Now look at something like the Vanguard Growth ETF, ticker VUG. This is where you'll find more of those aggressive growth-focused companies. The dividend yield, tiny, less than 0.5%. So yes, your $10,000 might only produce around $4 a month. $4, which sounds almost laughable. Why would anybody choose $4 over $33? Why would anybody pick less income on purpose? Because the goal in the accumulation phase is not to look rich, it's to become rich. And growth investing, especially early on, is built for that. High dividend funds can feel stable, they can feel comforting, they can feel productive because they're paying you, but many of them lag when the economy is expanding and growth stocks are doing what they do best, running. This is the part where patient investors separate themselves from emotional investors, because emotional investors want proof right now. They want money hitting the account. They want to feel progress. Patient investors understand that real wealth often looks boring in the beginning, quiet, unimpressive, even a little disappointing, until one day it isn't. And now we get to the part that can genuinely change the way you invest forever. Listen carefully, because this is where the entire argument becomes crystal clear. Let's say you're 25 years old. You invest $10,000, and then you leave it alone until age 65. No touching it, no panic selling, no interrupting the process, just time and compounding. Scenario A, you choose the safer, higher dividend route. Your portfolio earns an average annual return of 8%. After 40 years, your money grows to about $217,000. And honestly, that's not bad. That's respectable. That's what most people would call a success. But now, scenario B. Instead of prioritizing dividend income early, you prioritize growth, and you earn just 2% more per year. Not 10% more, not some crazy unrealistic number, just 2 extra percentage points. So instead of 8%, you earn 10% annually. After the same 40 years, your $10,000 becomes about $452,000. Let that hit. $217,000 versus $452,000. That tiny difference in return created a gap of more than $235,000. $235,000 gone. All because you wanted the comfort of $33 a month. That is the hidden cost. That is the trade-off. That is the mistake. And most people never see it because they're too focused on the tiny cash flow in front of them to notice the massive wealth they're sacrificing behind the scenes. So ask yourself honestly, was that monthly dinner worth $235,000? Because that's the real comparison. Not $33 versus $4. It's $33 today versus financial freedom later. And when you frame it that way, the answer gets a lot clearer. This is why I tell people with long time horizons, stop obsessing over dividends too early. Ignore the emotional thrill of seeing a tiny cash deposit hit your account. For a small portfolio, that feeling can become a trap. It makes you feel like you're making progress while quietly reducing your total upside. And for young investors, your biggest asset is not yield, it's time. Time is what turns average returns into extraordinary outcomes. Time is what gives growth its power. Time is what makes patience look genius in hindsight. Now, does that mean dividends are bad? No, not at all. Dividends are a tool, a good tool, a powerful tool, but only when you use them for the right job. And this is the part that many finance channels leave out. Dividends make a lot more sense after you've built the wealth, not before. In other words, dividends are for when you've already won the game, when you're nearing retirement or already there, and now you want your portfolio to generate income. That's when income-producing assets can really shine. Things like real estate investment trusts, energy ETFs, stable companies with reliable cash flow. That's when a 3% yield actually matters, because now it's sitting on top of a much larger portfolio. 3% on $10,000 is tiny. 3% on $1 million? Now we're talking. And if you absolutely want to buy individual dividend stocks right now, at least be selective. Look for dividend aristocrats, companies that have increased their payouts for 25 straight years or more. Look for healthy payout ratios, somewhere around 50 to 60%, because that tells you the dividend may actually be sustainable. But always remember this. Every dollar a company pays you out is a dollar it is not using to expand, innovate, hire, acquire, or grow faster. That doesn't make dividends bad, it just means there is always a trade-off, and smart investors understand the trade-off. So here's the big takeaway. Your first $10,000 is not income. It's a seed. And if you treat that seed like a paycheck too early, you may never get the forest. Don't eat the seed while it's still a sprout. Let it grow. Let it compound. Let time do the heavy lifting. Because the people who build real wealth are usually not the ones chasing tiny checks today. They're the ones building something much bigger in silence. If you want the strongest possible chance of turning $10,000 into something life-changing, focus on total return first. Focus on growth first. Focus on accumulation first. Then, later, when the portfolio is big, when the foundation is strong, when the game is already won, that's when you can flip the machine into income mode. And that's how you play this intelligently. So if you want more deep dives on how to actually build that $452,000 future, hit subscribe and give this video a like. It helps the channel, and it helps me keep making content that actually moves your finances forward. Stop chasing pennies today so you can catch hundreds of thousands tomorrow. I'll see you in the next video.